Welcome, everyone. This is a webinar. It's an introduction to 1031 exchange basics and the delayed exchange time deadlines. I'm going to be your presenter. I'm Scott Saunders. I'm a Senior Vice President with Asset Preservation, Inc. Asset Preservation is a leading national qualified intermediary, and we facilitate exchanges nationwide. We're going to be covering an introduction, so I want to make it really clear. This is just a fairly brief overview of 1031 exchange basics and the principles and some time deadlines. We encourage every exchanger, anybody that's doing a 1031 exchange, to consult with your tax and or legal advisors before closing on the sale of a relinquished property. Very important that you get your tax advisor involved prior to closing to review your transaction. With that, we want to jump into a really exciting subject, which is the subject of 1031 exchanges. A 1031 exchange is a very powerful provision in the tax code. It's been in the code, believe it or not, since 1921. What it does is it allows any real estate investor or business owner, what I'll refer to in this presentation as a taxpayer, to defer paying capital gain taxes that would ordinarily be owed in a taxable sale when they perform a 1031 exchange. So it really provides real estate investors and business owners potentially with a very significant tax advantage when they exchange one property for other what is called like-kind property. Now, the rationale is very straightforward, which is really there's no point in taxing somebody until they actually sell a property for cash. So when we do an exchange, the concept is that of continuity of investment liquidity, that you're merely giving up one asset, one property you own, and acquiring a different type of property, but all the money is staying invested in real estate. And somebody's not actually liquidating and selling for cash. And that's why taxes aren't owed until that point in time when somebody actually sells the property for cash down the road. Now, we look at what we call in the next slide, the perfect storm for 1031 exchanges. And really what we're facing now in the marketplace is a dynamic where we've got significantly higher capital gain taxes. In fact, back in 2013, capital gain taxes went up percentage-wise 58% from where they were before. So we had an increase in the capital gain tax rate, and we also had the addition of what's called the net investment income tax, which is an additional 3.8% tax for certain higher earners that fall over some certain thresholds. So it can be a much more significant tax liability now than it was in the past. In addition to that, what's really driving the dramatic increase in 1031 activity is the fact that we've had very strong real estate markets. And when I say markets, I'm referring to both the commercial real estate market as well as the residential real estate market. So commercially, we've had a very long run and an increase in property values. In fact, people that bought at the very bottom of the market back in, let's say, 2009 timeframe, they've literally seen their investment more than double in value nationally. So commercial real estate is very, very strong, and we've seen, a huge amount of appreciation, increases in prices. On the residential side, same dynamic, maybe not quite as dramatic, but yet a significant increase in prices. There's been a lack of inventory, not as much new construction as we've seen in other economic cycles. And so we've got limited inventory, and with the laws of supply and demand, that's really pushing up prices. So you've got, on the residential side, home prices in many markets are much higher than they were even at the previous market peak way back in 2007. And the bottom line is that we have a lot of real estate investors and business owners that are looking for ways to potentially reduce paying taxes in the current tax year, and they're exploring 1031 exchange tax deferral as a way to do that. Now, real estate investors, use 1031 exchanges to achieve a whole wide range of different motives. Certainly, they can leverage a property that has a lot of equity in it and put some financing on one replacement property that's larger, or maybe on multiple replacement properties. Investors can use a 1031 exchange to diversify, and they can diversify by geographically, going from maybe having all the assets in one area and maybe spreading out and doing an exchange into other states or other areas of economic opportunity. Or they can diversify by the types of investments. Maybe somebody who's in single-family homes is going to exchange into commercial, or somebody that's in office will go into industrial or self-storage. So lots of different opportunities, and we'll look at this shortly in terms of what's like-kind property. Some real estate investors take advantage of consolidating, maybe exchanging from a number of smaller single-family rentals into one larger property, maybe a commercial property, multifamily property. Cash flow. Those that have a lot of equity and gain in land might want to exchange that for improved property that produces cash flow and also some tax benefits. Management relief might be, again, exchanging into commercial or multifamily. And those investors that have fully depreciated their properties to take advantage of a 1031 exchange to go up in value and start getting some new depreciation that they can take advantage of. Finally, some investors might use a 1031 exchange for estate planning purposes, looking at what assets they have and maybe reallocating, taking advantage of a 1031 exchange to acquire some smaller properties that they might be able to designate that they leave behind for different heirs in a different manner. So a lot of different opportunities. Let's look at the backdrop of what somebody who's going to sell. If you don't do an exchange, you really face 4 potential components where you'll have to pay taxes. First off, taxes on depreciation recapture are taxed at 25%. So if you're an investor and you've owned a property for, let's say, the last 20 years, all of that depreciation that you've taken over the last 20 years, you will now have to recapture that and pay taxes on that at a rate of 25%. The remaining economic gain is taxed at the federal level at a rate of either 15 or 20%, depending upon your income. So those that are higher earners at the top rates would be paying 20%. Lower thresholds would be paying at a 15% rate. Then the third component, and this applies to, again, higher earners, those that are over a certain threshold will have to pay this 3.8% net investment income tax. So single filers that have more than $200,000 in net investment income would face this additional 3.8% tax. Married couples filing jointly over $250,000 in income would have to pay that. And then finally, the state tax can be a huge component to keep in mind. So some states have no taxes at all. Other states have fairly significant taxes. In California, the maximum state tax rate is 13.3%. So again, you want to look at all 4 levels of taxation to determine what would be the total amount you'll be paying in taxes. And again, a reminder, it's really important that you talk to your tax advisor, your CPA, your accountant, prior to closing on the sale of a property to find out what you'll actually be paying in taxes absent doing a 1031 exchange. We find that a lot of real estate investors are very surprised that they end up owing the government a lot more in taxes that really eats into that gross equity, and they're left with a lot less at the end of the day. And that's why people consider 1031 exchanges. Now, when you hold an investment property, you really have just a few limited options available to you once you buy it. One is a buy and hold strategy. And that's to buy a piece of real estate and to hold it for a long, long time. And a lot of investors do that, and certainly that's a popular approach. I just want to propose that if you happen to buy a property in a part of the marketplace where there's not a lot of job growth, there's not a lot of economic growth, there might be a significant opportunity cost that you're missing out on some upside by not being in a part of the marketplace that's growing and where there's a lot of upward pressure on prices. And a 1031 exchange can allow you to exchange out of that property now and exchange for a property in a part of the country or in your local market that's going to have a lot more upward potential, a lot more appreciation long term. Second alternative is to sell the property today and pay all of the taxes owed. So sell the property and pay potentially the depreciation recapture, the federal capital gain taxes, the net investment income tax of 3.8% when it's applicable, and your state tax. then invest that money after tax into investments that are not in real estate. Now, here's the big challenge with this approach. It's very, very difficult to get the same return on investment with after-tax dollars, after paying those taxes, as it is getting the same return on investment by keeping all of that gross equity reinvested into another property. So this is an approach, but you might have to settle for a lower rate of return by taking that approach. Third option is to do a 1031 exchange, and there are a couple of ways to do this. One is you can do a fully deferred exchange where you defer all capital gain taxes. Another one is you could do what we call a partial exchange, where you acquire maybe one replacement property, but then you pay some taxes on some of the cash that you pull out of the transaction. That's called cash boot. And by the way, I'll kind of give you the definition of that. Sometimes you hear that word. Boot is simply defined as non-like-kind property. So cash boot are cash proceeds you pull out of the transaction. Mortgage boot is a reduction in your mortgage liabilities on the replacement property compared to your mortgage liabilities on the relinquished property. And sometimes you'll hear mortgage boot referred to as debt relief. Now let's just look at the code itself. I mentioned earlier, it's been around since 1921, and so literally there are millions and millions of exchanges every year. Here's what the code states. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of a like kind, which is to be held either for productive use in a trade or business or for investment. Some key things to take away from the code. Number one is this is what we call non-recognition treatment. So you'll notice that if you do an exchange, you're not paying capital gain taxes in this tax year, but it's not a tax-free exchange. The gain is merely deferred to a later point in time. So it doesn't go away. It's tax deferral, not tax exclusion. Now, when we look at the types of property that qualify, they're very, very broad. It could be an investment property exchanged for an investment property. It can be a business property for another business property. It can be an investment property exchanged for a business property. It can be a business property exchanged for an investment property. So we'll look at this in a little more detail in just a few slides as to this whole concept of a like kind. But you're going to find when we deal with real estate, it's very, very broad. There are a few things that are accepted out. You'll see this on the next slide. Stock in trade or other property held primarily for sale is excluded. So if your intent is to hold a property for sale purposes, not for long-term investment, that's excluded from 1031 exchange treatment. So you can't do an exchange on that. In real estate, we oftentimes hear the term a fix and flip. Somebody gets a property at a low value, maybe at a really good purchase. They put a little bit of work into it, and then shortly thereafter, they put it back on the marketplace for the short-term profit. That type of property, even though you might make a profit on it, it's not being held for investment, it's being held for sale, and that's excluded from Section 1031 exchange treatment. Again, working with your tax advisor and with a reputable qualified intermediary like Asset Preservation, we can kind of go through the list of factors that the IRS will examine to help determine, does it tend to take on more of a flavor, a character of being held for sale or being held for long-term investment? So that's beyond the scope of an introductory webinar like this. Fourth bullet point down, a partnership interest is excluded from Section 1031 exchange treatment. So an interest in a partnership is not really an interest in the capital asset. You really own an interest that's considered personal property. The partnership owns real property. So if you have a partnership with, let's say, 3 partners, the partnership can do an exchange. And by the way, keep in mind, any entity at the entity level can do a 1031 exchange. A partnership can do an exchange. An LLC can do an exchange. An S-Corp can do an exchange. A C-Corp, a trust, an individual. However, the interest in that, if you have 3 partners and 2 of them want to exchange, they cannot exchange a partnership interest because that's a personal property interest. The partnership owns real property. An interest in a partnership or a membership interest in an LLC is excluded. And again, there are some planning strategies on this. There are some different ways of approaching this that are beyond the scope of an introductory webinar, but you can certainly consult with your tax advisor. And again, give us a call at Asset Preservation. We'd be happy to walk through some of the issues you face in those scenarios. Now let's switch gears a little bit. Let's look at like-kind property, and you'll see on the screen a whole bunch of different images of property. You'll see there's a vineyard on there. There's a farm. There's a ski cabin, a commercial office building, apartments, industrial building, all sorts of different types of real property that qualify for 1031 exchange tax deferral. So any real property held for use in a trade or business or for investment can be exchanged for any other real property held for productive use in a trade or business or for investment. So land can be exchanged for improved property. That sometimes is kind of a common myth out there. Does it have to be land for land or improved for improved? If it's real property, it can be exchanged for any other type of real property that's held for investment purposes. The types of property when we deal with real estate that are excluded, first off would be the principal residence. The house that you live in is not held for investment. It's a primary residence. So you can't do a 1031 exchange out of your residence. The only other type of property would be property that's held for sale purposes. Sometimes it's referred to as dealer property. So that's what's excluded. Anything that's considered real estate can be exchanged for any other real estate. When we deal with personal property, it's much more limited and restricted. Only personal property that's considered like class or is under the same North American Standard Industrial Classification can be exchanged for similar property. So a corporate aircraft can be exchanged for corporate aircraft, collectible artwork for collectible artwork, rental cars for rental cars. Much more narrow and specific with personal property. And again, I don't want to go too far down the road. The vast majority of exchanges that we are involved with at Asset Preservation are real property exchanges. And again, that's something when you've got maybe a sale of a hotel or something like that where you've got both personal and real property that you'll want to consult with your tax advisor and Asset Preservation to discuss some of the issues when you've got those types of properties. Now, the next slide talks about something that's really important. For a taxpayer to get 1031 exchange deferral, the intent must be to hold for investment purposes. So the intent, when you think about it, is really something that's very internal and subjective. The IRS and the tax courts, they're really going to look for what objective factors are out there that either tend to support or contradict the taxpayer's intent to hold for investment. And the IRS will look at all of the facts and circumstances. Now, certainly, the amount of time that somebody holds a property is an important factor. So that holding period is important, but there's not a specific holding period anywhere in the tax code. What is more important is the intent to hold for investment. And, we can address later on, and certainly we will on a more advanced type webinar, different time frames. But just keep in mind the holding period is important, but it's one of many factors that the IRS can look at. If you note there on the screen, there's a tax court decision from 2010, Goolsbee versus Commissioner. This is one where somebody moved into a property as a residence right after the exchange. It didn't qualify for 1031 exchange deferral. In the second case, Reesink versus Commissioner, in 2012, the taxpayer had a relatively short holding period, only 8 months. However, they had a lot of facts and circumstances that showed that their intent with the property was to hold for long-term investment. And therefore, the IRS allowed 1031 exchange deferral. So again, on a more advanced presentation, we'll go through some of these different factors. But just keep in mind there is no set holding period. It really comes down to your intent, your unique facts and circumstances, and most importantly, what sort of documentation, what sort of paper trail have you put in place supporting that intent to hold for investment? Now, there's something on the next slide that's coming up called the exchange equation. These are the rules for full tax deferral. So if you want to obtain 100% tax deferral, you really have to meet just two requirements. Number one, reinvest all of the net exchange proceeds. Number two, acquire property with the same or greater amount of debt. So on the first one, you're going to look at the net proceeds. This would be after closing costs, after real estate commissions, the title company's fees, things of that nature. It's the net proceeds. And remember, any money you pull out is called cash boot. The debt, you really look at the mortgage payoff on the property being sold, and then you look at the mortgages acquired, the new debt on replacement property or properties. So you can exchange out of one property and acquire three, let's say, replacement properties. You're going to look at the combined debt. Any reduction in debt, again, is called mortgage boot or debt relief. So I'll go through a few examples quickly to help illustrate this. Taxpayer sells a property worth $900,000 with a mortgage payoff and debt of $300,000. Cost of sale are $60,000, leaving net equity of $540,000. They exchange up in value for a property worth $1.2 million. Their debt goes from $300,000 to $660,000, so there's no mortgage boot. They reinvest all of the net equity, so there's no cash boot. So this is an example of full tax deferral. Now on the next slide, we're going to see partial tax deferral. Somebody sells with the same numbers. They buy for $700,000. Their debt goes from $300,000 down to $260,000. So we have $40,000 of mortgage boot. Net equity goes from $540,000 down to $440,000. There's $100,000 of cash boot. We add those two together, and the total boot in this example is $140,000. One final illustration: somebody goes and reinvests all their cash, but they go down in mortgage by $40,000. They have $40,000 of mortgage boot. So the takeaway to keep in mind is this. You really want to look at the net equity and see if all of that's reinvested for full tax deferral and the mortgage amount. To the extent that you put money in your pocket, that's cash boot. To the extent you go down in mortgage liabilities, that's called mortgage boot. And one last note, it's not on the slide. You can offset mortgage boot by adding cash. So if you go down in debt, but take some outside cash to offset that reduction in debt, that's permitted. On the next slide, the general principle is the way that you exchange out of a relinquished property is the same way that you want to acquire the replacement property. So if you come out in your own name, you want to acquire in your own name. If an LLC relinquishes, you want the same LLC to acquire. So the real central issue is making sure it's the same tax owner of the relinquished property is the same tax owner of the replacement property. And again, when we get into more complex transactions, we'll deal with this in later webinars, some of the subtleties here, because there are issues, particularly on commercial transactions, where somebody may come out as an individual, but they may acquire a replacement property in an LLC, limited liability company, that's disregarded for federal tax purposes. And that would be permitted because it's the same tax owner. Now, on the next slide, we're going to go through the basics of a delayed exchange. Taxpayers up top. So the taxpayer is the person selling investment property. The property is listed. Once the property is under contract, that's the time when you want to contact a qualified intermediary. And let me drive home a very important point. It's essential that you set up the 1031 exchange prior to closing. You can't come back after the property's closed and try and set up an exchange after the fact. Very, very important that you set the exchange up before closing. So property gets under contract. The taxpayer contacts a qualified intermediary. And by the way, the qualified intermediary is the term the IRS uses. Sometimes you'll hear that referred to as a QI, sometimes an intermediary, sometimes a facilitator, sometimes an accommodator. Those are all synonymous terms. The taxpayer contacts a qualified intermediary, and the intermediary prepares some paperwork and forwards it to the closer, so the closing officer at the title company or the closing attorney, if it's being handled out east, And really what that paperwork does is there's an exchange agreement, there's an assignment of the contract and a notice of assignment, there's some instructions to the closing officer, and there are some account setup forms. But the qualified intermediary, through an assignment of the contract, steps into the shoes of the taxpayer. So the qualified intermediary sells the property to the buyer. So you'll see the money going from the buyer to the qualified intermediary. The qualified intermediary instructs the closing officer to directly deed the property from the taxpayer to the buyer. So that's the first part of an exchange. Then the taxpayer looks for a property they want to buy. They make an offer, the property is under contract, they again contact the qualified intermediary, and the intermediary prepares some paperwork for the closing officer on the purchase side. We, the intermediary, qualified intermediary, we now step into the shoes as the purchaser, the buyer of the replacement property. So you see the money coming from us, we're buying the replacement property, and we instruct the closing officer to directly deed that property back to the taxpayer. So the qualified intermediary sells the relinquished property, the qualified intermediary purchases the replacement property, and the taxpayer is merely giving up title, a deed, and receiving a deed back. You'll see at the bottom of this chart some very important timelines. Day zero happens when the property closes. So what that starts are two different timelines. From the closing date, the taxpayer has up to midnight of the 45th day, what we call the 45-day identification period, to identify a replacement property or replacement properties. They then have a maximum of 180 calendar days or the date they must file their tax return, whichever is earlier, to complete the exchange. So it's a maximum of 180 calendar days. So they're going to go through weekends, through holidays. So another way to look at this would be 45 days to identify, plus another 135 days for a total of 180 days possible to complete the exchange. When we talk about identifying, sometimes people think, well, does the property have to be under contract? And the answer is no. It doesn't have to be under contract. It just needs to be identified in writing, unambiguously described, and then provided in writing, generally to the qualified intermediary, by midnight of the 45th day. There are three different rules. So under a delayed exchange, the most popular rule is the three-property rule. The taxpayer can identify three properties of any fair market value. So they're limited on the number of properties, but there's an unlimited value. So you sell for $1 million, you can identify one property at $1 million, one at $2 million, and one at $5 million. But you're limited to three under the three-property rule. The 200% rule is kind of the reverse of that. It's an unlimited number of properties, but now you're limited in value. So you can identify as many properties as you want, but no more than 200% of the fair market value of the property that was sold. So again, if you sell for $1 million, then you can go ahead and identify as many properties as you want, but not over $2 million. And then finally, there's what's called the 95% rule. Under the 95% rule, a taxpayer can identify an unlimited number of properties of unlimited value. However, they must actually acquire, meaning close on, at least 95% of the value of all properties identified. So this one, even though it sometimes is used, is probably the most challenging. So it's a part of the code and the Treasury regulations, and it's a way that you can identify. By far, the three-property rule is the most common, followed by the 200% rule. Rarely do we really see at asset preservation many people taking advantage of the 95% rule. Now, something I'll just touch upon are what we call parking arrangement transactions. These are situations where an entity owned by the qualified intermediary is actually parked on title to a property, and that's why they're called a parking arrangement. We would form generally an LLC, a limited liability company, which in 1031 exchange speak is called an EAT, an exchange accommodation title holder. Really, we're just parked on title. There are three different scenarios of parking arrangements. We can perform what's called a reverse exchange, where we purchase the replacement property first and then have up to 180 days to sell the relinquished property. under the Revenue Procedure 2000-37. We can perform an improvement exchange. So this is one where we would either make improvements to an existing property or build a brand new property from the ground up in a parking arrangement. And then finally, the last scenario is a reverse improvement exchange. This is where we buy the new property first on behalf of the taxpayer, begin making improvements to it, and then have up to 180 days to sell the relinquished property. And we see a lot of owner users take advantage of this strategy. So these are all much more complex transactions. Generally, a lot of times we'll see these in commercial type exchanges where somebody's got a real challenging situation. Maybe they must close on a purchase, or there's a pocket listing where the seller needs to close, or maybe they need to build something into their own specifications. We'll save this for more advanced webinars down the road, but wanted to at least share those strategies with you. On the next slide, you'll see that there are a number of different tax code provisions that help real estate investors. We've been talking about Section 1031, which provides for tax deferral, so that basis rolls over into the replacement property. Section 121, many of you may be familiar with. This deals with the sale of a residence where somebody lives in a property 2 out of 5 years, and this is tax exclusion. So there are different provisions for different purposes. On the next slide, and I'm not going to go into all these scenarios on this particular webinar, you can see that we can do what's called a split treatment transaction, where somebody maybe lives in part of a property and some of it's rented or used in a farm or ranch. We can convert a rental property acquired in an exchange later on into a residence. And you might have a scenario where somebody lived in a property and they want to go ahead and convert it to a rental and take advantage of both Section 121 tax exclusion and also take advantage of Section 1031 tax deferral. One of the most important issues to look at in any exchange is really looking at the qualified intermediary and the security of the funds. Really, really important to do that. You'll see on the slide a handful of states have some state-level consumer protection laws regarding 1031 exchanges and qualified intermediaries. However, there are no regulations at all at the federal level governing the 1031 exchange qualified intermediary industry. So there's some things you want to look at. It's really important that you look at the exchange funds that are being held. First off, does that intermediary deposit that money into a segregated account? You don't want your money commingled. You want a separate and segregated account set up for each exchange transaction. The qualified intermediary can also offer qualified escrow or trust accounts. You can certainly explore the fidelity bond coverage. And certainly you want to look and see, does that intermediary, do they have a very large parent company that backs them up? Our parent company at Asset Preservation is Stewart. Stewart Title, publicly traded, is New York stock symbol is STC, New York Stock Exchange symbol, STC. Stewart's been in business for over 125 years. And upon request, they will provide a letter of assurance from the parent company backing the proceeds. So you want to see what are sort of security mechanisms are in place. We believe at Asset Preservation, we offer the highest levels of proceed security in the 1031 exchange industry. You can certainly look and see, is the qualified intermediary a member of the National Trade Association? That's the Federation of Exchange Accommodators. Many reputable qualified intermediaries belong to this organization. Their website's 1031.org. Finally, in a very brief introductory webinar, I can't cover every scenario. What's really important is that you speak to a 1031 exchange expert and discuss your unique facts and circumstances and get input on your transaction. So feel free to contact Asset Preservation either at our headquarters in Roseville, California at 800-282-1031 or our office in New York, our Eastern Region office at 866-394-1031. We have a website, apiexchange.com, that has a lot of information that will help you learn about the exchange process. But more important than even our website is really talking to a live person at Asset Preservation and getting input on your specific and unique exchange transaction. If you're more comfortable reaching out by email, our email is info@apiexchange.com, and that's monitored by senior management. And we get lots and lots of email inquiries every single day, and we try to provide fast and responsive service. So thank you for your time. Hopefully it's given you a good basic introduction of exchanges. Stay tuned. We have more advanced 1031 exchange webinars coming up, and we look forward to educating you on the process, and we want to be a valuable resource to you if you're an investor, to your clients if you're a real estate professional, CPA, attorney, or financial advisor. And we really strive to provide excellent and responsive service on each and every 1031 exchange that we facilitate. Thank you for your time.